Hey guys, welcome back to another video. So today I want to talk about a company that I've been looking at recently. It's very attractive right now at its current valuation, and this company is Pubmatic. So Pubmatic is a cloud-based ad buying platform, and it allows publishers to sell their ad space to advertisers. While most companies have advertising as an expense, Pubmatic actually thrives on it as a revenue stream. And it's able to take advantage of the money being spent on digital advertising, which hit $763 billion in 2021, and it now accounts for over 64% of total advertising. In 2020, digital advertising made up 60% of advertising, and in 2019 it made up 52%. So you can see that the digital advertising space is growing very big, and Pubmatic is one of the key players. Right now, its stock is trading at $26.48. It's down 58% from its 52-week high of $62.25. And it has a market cap over $1 billion with a one-year target estimate of $42.60. By the way, don't forget to subscribe and like the video if you have not already. Now, if we go to their earnings, you can see here that they're estimated to make 65 cents a share this year and 88 cents a share next year. And that would be a 25% this year from last year, and then another 23% next year. Now, the reason why they're not earning as much per share is because there's obviously less people to target with digital shares right now because of everybody going back out and going back to their jobs and not staying home as much. But also this company is reinvesting more into itself, and I think that's good, especially since they're profitable. This is definitely a good time to take a lot of the profits that they made from last year, and they're still going to make quite a bit of profits this year and just reinvest it back into the business. Now you can see their profit margins are pretty good, but they definitely could be better. They're around 25% for profit and 25% operating. It'd definitely be nicer to see that closer to maybe like 40%. Now they have plenty of cash on hand and hardly any debt, which I think is really good. This is really nice to see, especially for a company that IPO'd about 2 years ago. Now you can see here on this chart that the digital ad spend, it's just been growing and growing. You know, in 2021 it grew 31% year over year, and all this ad spending has just been accelerated by the pandemic. You can see here the blue is pre-pandemic projections and the yellow is with the current projections. Everything, a lot of things digital just got accelerated by the pandemic, and Pubmatic is a company that has definitely benefited and will continue to benefit from that. Now, right now, Pubmatic, it's a big player, but it's not a huge player in this digital advertising space or in the advertising space in general. So here you can see Pubmatic has a 3 to 4% market share, which is basically grown 1 percentage point year over year, but their long-term market share objective is 20% plus. So this is really important because, you know, this space is going to continue to grow, but even if this space stopped growing completely, Pubmatic wants to have a 20% market share, which would be about a 5x from here. So that's pretty crazy. So you can see here some of the places that Pubmatic wants to target. You know, these are very big places and very important places in the world. So if Pubmatic is able to gain market share dominance here in these places, that'll be really important. And it's very important for this company to be global. Now you can see here that the global retail media ad spend is expected to grow 23% year over year from 2021 to 2024. So that's really good growth in the advertising space. For revenue, they grew 53% year over year. Their GAAP net income margin grew 25%, and their adjusted EBITDA grew 42%. You can see here, this is a comparison of Magnite and Pubmatic. Magnite is one of Pubmatic's biggest competitors, and this is one of the reasons that I'm looking to buy into the stock. And it's because you can see here that right now, Pubmatic, its shares, only 52% of shares are held by institutions, and whereas you can see on Magnite, 68% of shares are held by institutions. So I think there's still a lot of institutional money to flow into this stock. It's not too big a difference, but it's enough of a difference to really push the stock price up. And I think once Wall Street really sees what this company can do on a global scale, they're just going to start investing heavily into this stock, and we could see similar numbers to Magnite. Now, as far as a one-year target projection goes, you can see here, according to 16 stock analysts, the average 12-month stock price forecast for Pubmatic is $43.45, which predicts an increase of 64%, which is really good. The lowest target is $30 and the highest is $51.45. Now their lowest target, $30, this is actually less than their current stock price. So even if you bought now, you're buying at a really good valuation. Now here are my 2030 target projections for stock price, and you'll be pretty happy with this. So if we take their current revenue, which is expected to be $284 million this year, and for the next 8 years it grows at a 20% rate year over year, which I think is more than fair. It could grow a lot more, maybe up to 30%, but I'm going to say 20 just to stay conservative. That would put the revenue at $1.221 billion in the year 2030. And if we take their current outstanding shares and they grow at a 2% rate each year because of share dilution, to compensate all their employees, then there's going to be about 47 million shares in 2030. Now, if we use the forward price to sales ratio of 5 to calculate their stock price, which is really fair when you compare it to other companies like Facebook, which is really digital and it's actually really undervalued right now, then we can use their 2030 revenue times 5 to get their market cap, and then we would take their market cap divided by the outstanding shares in 2030, which would give them a $127.86 share price in 2030. That's actually a 5x from here, and it's an easy 5x. I think this is a very safe company to be in because there's a lot of other companies that you're not exactly sure how much they could really grow. I think this one's a lot easier to calculate, it's a lot easier to project, and this is a business model that's very profitable. So it's really nice to see this. I think this is a nice and safe company. Obviously, there's other companies that could grow more than 20% a year, but I could see this company growing for 20% a year for way longer than 8 years. This could be for the next 15 years. This company just keeps growing by 20%, which would make this a really, really good long-term safe investment. But those are my thoughts on this stock. Just let me know what you guys think. And if you haven't already, just make sure to like, comment, and subscribe, and I'll see you guys next time.